Hi, welcome back to Quiddity Podcast. This is season 5, episode 6. Today I'm joined with Nathan and Rich, who between the two of them will help us understand bridging finance, how to enter title split blocks of flats, as well as to exit it. So they're going to help us understand why bridging is one of the best ways of actually getting into properties now. And I'm sure he's going to say this. Rich and I have been working together for 10 years now. And when I first met Rich, I was anti-bridging. And so now I am super pro-bridging because there's some reasons why. And hopefully in this podcast, we're going to explain what they are. So, gents, welcome.
Thank you.
Thank you for having us.
Welcome again, Rich. And Nathan, welcome from Castle Trust. So thank you for giving us some time to be here.
Nice pleasure.
So one of the things, we're going to get this out of the way. Rich, can you explain why I was anti-bridging 10, 15 years ago?
Cost, uncertainty, and pressure.
And lack of understanding, maybe as well.
Lack of understanding as well. Yeah,
I think
there are some horror stories out there as well, you know, and kind of sitting around a table at the pub and say, "Oh, don't use bridging finance; it's expensive, and they'll take everything you've got if it goes wrong." But it's a means to an end, and it's definitely not as scary if you've got the right people helping you through that process.
And I think that's so true. I mean, the challenge you always hear bad news, right? You never hear the ones that did really well with the bridging and they exited on which we're going to talk about in this episode as well. But you're right. I think my learning over the last kind of 15, 20 years of bridging or not bridging and then bridging loads is the people who complain, they don't understand what they were doing. Because if you understand how to buy the right building with the right finance mechanism, you'll be fine.
Absolutely.
Right. So, Nathan, in a nutshell, what is bridging finance?
I would say it's a tool that is in place to obviously obtain assets quickly, especially if you're looking to do refurbishment works, which is obviously where it's key. Yeah. And obviously, it just allows you time to, to kind of come in and purchase that asset quickly, essentially. Yeah.
So would you say, the way I look at it, is access to money that you would not normally get with a traditional mortgage?
I would say so, yeah. I think that's fair to say.
I agree with that.
Yeah. So why would I buy something on a bridge and not a traditional mortgage? And I'll go, Nathan.
Yeah, I would say, I mean, for us anyway at Castle Trust, 9 times out of 10, it's because there's people doing works. They see an asset which is, has potential. It could be a block of flats, for example, where the value is in splitting the leases and obviously doing a little bit of refurbished work. Yeah. So then that allows them, 12 months, as a rule of thumb, I say, to kind of get the funding in place and then ultimately do the works, refinance, split the titles, whether it may be, and obviously go off that higher value via your traditional way of mortgages, I suppose.
Yeah. Same question to you.
I agree with that. I think the key thing is that, especially when we're looking at a title splitting strategy, you don't just want to get a 75% off the purchase price and leave all your money there.
Correct.
So yes, you might be able to get a mortgage if the block is in a livable, lettable condition. Yeah. But that's not what we're looking to achieve. We're looking to try and recycle the cash out to be able to go again.
Yes.
And bridging allows you to do that, whereas a mortgage doesn't.
And I think just to add a little bit to that, with my own experiences, you could be buying stuff and we'll talk about this maybe later on or another session or another episode around split on entry. So we can actually get a higher value of the block that we're buying and get 75% of almost the entry GDV, which then the bridger are more happy to finance. The other thing that I found with bridging, helpful with bridging, is speed. Very quick on an auction timelines. Also, another thing that I found with working with Richard is we can get bridging on desktop valuation. I mean, these are some of the stuff that not every bridger does it. Not every time they will do it for different properties, but we have fixed some problems majorly by being able to get some time desktop valuation.
Mm-hmm. Absolutely.
Okay, so biggest mistake investors make with bridging. Nathan, what do you see? Where do people say, "Oh my God, Nathan, you said this, you said that. Now it's not worked out." What are the main?
I think it's at times people don't fully understand the deal. Okay. I think there's a lot that you need to kind of take into consideration, such as if it's a block of flats, for example, sizes. Yeah. If you're going to have a block of flats and they're made of, I don't know, 20 square meter flats and they're going to split the titles, they're not technically considered separately saleable.
Yeah.
So that's going to have a massive impact on how the lender looks at it, and because it most likely be block value as opposed to aggregate value, which is ultimately what the client's trying to achieve.
Correct.
So I'd say understanding of the deal is key.
Yeah. So the naivety of the investor is probably where a lot of people fail, or they lack the information that they should have.
I'd say so. Yeah.
What about the calculation of finance? Because bridging is not cheap, but and that's what everybody says, right? But then I've done the numbers with you, Rich. We've done almost an equivalent of if I bought a block with a bridge, or took a 2-year fixed mortgage on it and then paid the early repayment charges. Actually, I was shocked to see that when you come down to the early repayment charges and all the cost to it, the bridging finance funding was better than a longer term or a 2-year fixed mortgage.
Yep.
Did you agree with that, Rich?
Absolutely. I think if you're buying somewhere that doesn't require work, so it could be mortgaged, but you want to try and recycle your cash out, a bridge will typically over anywhere from sort of 3 to 7 months work out cheaper than taking a mortgage and then trying to refinance that and paying those early repayment charges.
Yeah. Okay. Bridge is expensive, Nathan. That's what people say.
Yeah, I think it gets a bit of a bad rep, really. But like Richard said, it does serve a purpose, and ultimately, I think, what clients should be thinking about at the same time is, well, I've got the bridge facility for 12 months, but I'm not going to sit there and wait for the 12 months. I think the brokers and obviously investors and entrepreneurs that succeed with bridging, their key in their philosophy, I suppose, is very much right. I've got it. Yeah. Let's do the work and get out. Yeah. And then that way, like you said, it doesn't really, the cost really is.
It's not an issue because for me, the way I have rationalized in my head with Richard is it's either we do the deal or we don't do the deal. So bridge allows us to do a deal that we may not otherwise have been able to do. And I think that's how investors really, and when I'm coaching people, is to if you've got the money and you can do the deal with a bridge, or you don't have enough money to do it outright cash or in any other way, then you're not making that deal happen. So it's a very easy choice to make that decision. Again, sticking to cost and process. So we find a block. I come to Rich, I come to the broker, and then they come to Castle Trust and say, okay, well, we're gonna Castle Trust will fund this. What is the process that is taking place in the background from a bank perspective or lender's perspective?
I suppose it's just making sure that obviously what you've told your broker and what that broker tells us kind of stacks up.
Yeah. So how do you check that? What kind of mechanisms going on?
It'd ultimately just be, checking Rightmove, just looking at the data, see what's in that area. Yeah. Because what we don't want to do is we don't want to set anyone up to fail. Correct. So especially for us at Castle Trust, anyway, it's very much if we can see that the deal works and we've done a little bit of RDD.
So who's doing that in-house for you?
I would say 9 times out of 10, inquiry stage. Obviously, it's myself. Yep. So that could just be checking the area, checking the rental income. Because obviously, what we don't want to do is go at 80% net or 90% net, and they can't exit. Yes. So. So I'd say that the DD that we carry out is essentially, does it work? Is it realistic? Yeah. And then seeing obviously what the value ultimately says when it comes down to it, I suppose, because you can put figures to us, and obviously we do see some crazy figures at times, and we
optimistic figures.
Yeah.
But I guess this is where you have people like Rich as brokers to almost attenuate this situation. So he's presenting the deal to you already, in a manner, having done a bit of that due diligence. Would you say that's fair?
Yeah, absolutely. And I think sometimes a deal won't work with a lender, but one of the nice things about Castle Trust is they will tell you that straight away. Yeah. We've actually had one of ours that is in the case studies later.
Yes, we will talk
went
about
to Castle Trust first of all. Yeah. Wasn't one for them, but they told us straight away before valuation stage, before we went too far down the process.
Yes. Do you know why that was? What for that specific? I can't remember why it wasn't for them.
That one was it's a title split deal, of course.
Yes, of course.
But it was one where the block was in an area that didn't seem to have a huge amount of other blocks of flats, so it was hard to then gauge the comparables and see whether or not they were going to be easily saleable.
Gotcha.
To both investors or owner occupiers. But that came out within, I think it was under a day of having the inquiry in. Yeah. it came back and it was like, this isn't one for us. So.
And I think that's one thing to say here about bridging finance. There are bridging finance companies, right? So there are, we work with some of the top ones that are been around for a while. They're not going to set you up for failure. They are more interested in a long-term relationship rather than a quick buck. And I think this is another issue with bridging finance because it is not FCA regulated kind of products, if you like. Some rogue tech people can get into that, and I think this is sometimes the other reason why people say, "Oh my God, I had a really bad, terrible experience." But again, working with brokers like Rich, banks and bridging finance company like Castle Trust and others that we use, not just Castle Trust, but it's important. There are some really good ones that we keep using over and over again to do that. Okay, so what is more important, Rich? What is more important, the deal itself of the bridge and the loans and the amount, the percentage, or the exit when it comes to bridging finance?
It has to be the exit.
Tell me more.
It has to be. So if almost anything can be funded.
Yeah.
Nathan mentioned there about having small studio flats that are maybe 60 meters, 20 square meters.
Yeah.
We could fund that on a bridge. There will be someone who is happy to take that on.
Yeah.
But I can almost guarantee that we won't be able to find someone to exit that deal in the way that the buyer wants to.
Yeah.
The whole idea about this and everything we do from a title split perspective is that we want to be able to buy the block, split the title, remortgage those individual units on buy-to-lets.
Yeah.
If that's going to fall down because we've got small studios, because there's commercial premises underneath, because there's a construction problem.
There's a smelly underneath somewhere, which a lot of banks don't like taking.
Absolutely.
And that falls through.
Then we could, as I said, we can still fund that. Yeah. There will be someone who will take that on a bridge.
Yeah.
But I want to make sure that I've already run that past half a dozen buy-to-let lenders to say, do we have our options?
And this is why the duo works here, because you can see here you have the bridging finance company on the right, and then you got Rich on the left as a broker trying to say, okay, we can get you in, but you need the team around you to be able to get you out of that deal. And that's where the brokers really come into it. So they use the bridge for the right product to get in, and then the exit. I know working with you, we work straight away. We buy it. Before we buy it, we know where we're going to exit and who we're going to exit.
The other thing with Castle Trust, of course, and it kind of gives us a fallback, is even if we could maybe approach a more mainstream buy-to-let lender, they typically won't take on the product on their bridging products.
Yes.
If they wouldn't be able to exit it themselves as well. Am I right in saying that?
Yeah. So for example, there's cases out there which we're happy to do the bridge on, but we might not be happy to do the buy-to-let on. But like you said, it's all about the trying to get that exit sorted.
The due diligence in advance.
I think most of them, from what we do, if it will exit with another buy-to-let lender, it's almost certainly going to exit with Castle Trust as well. And it just offers that fallback.
Yeah. And I think that's something, for the listeners here, you can find bridging finance companies that have got longer term product, because that's another fallacy where people say, but bridging is only for short term. We have got lenders that will lend on entry, but also then on longer term product as well.
Absolutely. I think going back to something you were saying earlier as well, it's for me as a broker, whenever I'm trying to place one of these deals, it's lenders that will quickly say no are more important than lenders that will quickly say yes. I would rather someone right at the outset says this isn't one for us, because there are enough lenders. Than someone who says, this is one we can do.
And then 2 weeks later,
they say valuation stage or legal stage, something comes up that was available at the time that we presented it, that then turns that deal off.
And that can be a killer if you're doing an auction timelines, and then now your timelines are slipping as well.
Absolutely. I can replace a bridge in 3 working days, but I really don't want to. So try and avoid it where possible.
So some quick fire questions for you both. So what makes you say yes instantly to a deal, Nathan?
I'd say the due diligence, making sure it's been packaged correctly by a broker, like Richard. So that really helps.
So you get like an overview of the whole thing straight away.
Exactly. Any issues that may be an issue that we're aware of, so then we can, like you said, tackle it. If we're aware of it, then 9 times out of 10, if it is an auction purchase, we knew about it. We've already set time aside, if you like, to kind of combat that potential issue. So
perfect.
Understanding the deal, I'd say.
Richard, biggest red flag in an application process. What is your biggest red flag?
A lack of information. Lack of due diligence, that someone hasn't put the work in, and whenever we're doing our fact finding and our initial questioning, it's lots of blanks. You know, even as simple as what's the cost of works, and someone doesn't know the cost of works because I mean, as I know from personal projects, not getting those things priced up beforehand and not getting your trade sorted out.
It's a massive shock at the end.
Massive shock, and it will add 6 months onto your process.
And I think that's really fair. It's a fair due diligence. That's why it's there, because people are not realizing that 30,000, 40,000, 50,000 are going to be needed to finish that project. So you've got to put that cost in. If you haven't got it, and you're saying your biggest red flag is a form is filled half of it, and then there's loads of gaps. That means the person has not thought about it.
We know that speed is important, but speed without cutting corners.
Yes.
You know, still want you to have done the work before you've presented something to me, before you've gone to buy it at auction. Yeah. You already know what it's going to cost, what it's going to be worth at the end. Yeah. All of the nuances, where your deposit's coming from, all of these things that we can't leave up to chance.
Yes.
That's what speeds the process up once we get an application.
And one of the good things is, the good news is on the Quiddity platform, so we're launching a new landlord platform. So one of your checklist forms will be there. So one of the things that they will do is by the time you get a lead for a bridge, they would have filled in this form for you. So again, it's making sure people know what the information that's going to be needed for them to fill in before they get to that. So if you're listening here, you know, you can definitely look at the Quiddity deal calculator platform, which we're going to put some links on the show notes as well. Okay, next question. Typical loan to value range. What is your typical loan to value range on a bridge?
I mean, for us, if they're carrying out any sort of light refurb works, it could literally just be a matter of, you know, decorating, new carpets, something like that. That's what we need. But we can go to 80% net on our bridge.
80% of the purchase price.
Or if it's below market value, which in these instances they tend to be, then it's 90% net of the purchase price.
Which is one of the things that we will put after the show note, the case studies that we've done with Castle Trust, where we've had much higher than 75% loan to value, which is, as part of the title split course that people get, is you get access to these deals because we bought a £640,000 building for 40k. I mean, that's ridiculous, but now we're exiting and we're getting 900 valuation on it. So it does really work. Okay, rates. Currently, May 2026, what is the average rate that somebody should be thinking about paying per month on the bridge?
I think from a worst case scenario point of view, if you look at it costing you about 1% a month on a bridge, with a 2% arrangement fee and between 0 and 1% exit fee, that's your average annual
That's your average cost.
Yeah. Could be slightly higher if you're trying to squeeze the loan to value. Yeah. And there are lenders out there who offer a lot less if the deal's right.
And you can also get a development loan aspect of it afterwards. If works are being needed,
funding
you
for
can
the
actually
refurbishment.
get funding for refurbishment. Okay.
Absolutely.
Last two questions. Can first-time buyers, Nathan, get bridging finance?
Of course.
Okay. So is it just as simple for a first-time buyer to get bridging finance as long as the deal stacks, the due diligence has been done, there's meat on the bone, if you like, they can still get it?
100%. I mean, it all depends, again, like you said, on the deal. I mean, for us, for example, our criteria is if you're a first-time buyer and first-time landlord, then obviously it would have to be in an SPV, which is fine. So that's a limited company. But 9 times out of 10, they tend to be anyway.
Correct.
You know, so yeah, I think the key thing for first-time buyers is have a contractor. Make sure that you, like Richard said earlier, you know, understanding that there could be a cost of work element involved, what it's going to cost, who's going to carry out those works. And I think that's about it really for first-time buyers with bridging, I suppose.
Yep. Okay. And again, from my side, yes, absolutely fine with a first-time buyer, first-time landlord. But again, I want to make sure that the property is right for the exit, because exit options will be more limited for someone who's never done this before.
And I always say that on all my podcasts, the commercial broker, in this case Rich here, is your chaperone of the deal. You know, he will look on entry whether it's a good deal, during, and also more importantly on entry, what's the exit. I mean, it's critical to have the right people in place. We've got a bridging finance lender as well as a commercial broker here. So the last question goes to you, Rich. What is the one golden rule before taking a bridge that you would say to your investors, your buy-to-let investors or whatever they are? What would be the one golden rule?
Know your exit. Okay. I know we've kind of banged on about that quite a bit, but it's so important. It's to know how you're going to get off it, because that's where your profit is. You know, and wasting time once you've completed the works, not being able to get off the bridge because of the wrong lender being used, because we haven't put that work in beforehand to get that sorted.
Or the miscalculation on your schedule of works.
Absolutely. Or if you take 4 months too long or 4 months longer than expected doing the works because you didn't have the trades sorted out,
Yeah.
you know, that then impacts the exit because then we can't get enough money, and it snowballs from there. So I think everything to do with the exit is so important before we even go onto a bridge.
And I think just to wrap this up, I think I couldn't agree more. I mean, I've learned along the way of 25 years of working with people like Rich, people like Nathan, just you know, because they are asking question for a reason. And if you've got those answers, or if you don't know the question, you've got to then accept that you're going to ask and work with people like Rich, like Nathan, to get those questions answered. But from my perspective, when it comes to bridging, right now, 2026 March, everything that I buy is through a bridge. Why? Because it's the most cost-effective way of doing hundreds of deals rather than 2 deals. And done right, but buying the right blocks at the right price for the title split, we are working with companies like Castle Trust over and over again to be able to come in, but also sometimes to exit as well. And Rich, thank you so much for always helping us get the deal through, both on an entry point and an exit. So on that note, all I've got to say is thank you so much for coming today and sharing the experience, the knowledge, and answering some of the questions around bridging. This is not going to be a one-off event. We had the lawyers just before us, Renters' Rights Act. That's going to change how we function, how bridging finance companies look at some deals as well. So I would say that's one of the biggest things that we need to kind of all try help each other out over the next few months or so to kind of help investors maneuver this new way of working.
Absolutely.
But thank you so much, and we look forward to hopefully seeing you on the next episode of Quiddity Podcast.
Thank you.
Brilliant. Thank you.
Thank you.